It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Well, several retail names potentially facing material pressure stemming from the Red Sea crisis and Panama Canal drought restrictions. Among that list, we're placing two companies on investors' radar when looking at investing plays in retail and home furnishings retail in particular. Joining me now, Seth Basham, Wedbush Securities Managing Director of Equity Research. Thanks so much for being here, Seth.
Thanks for having me.
So let's get to your goodbye, the one you like first of all, and that is Williams-Sonoma. And Williams-Sonoma, interesting case here because, first of all, the stock has already done quite well over the last year. But let's get right to your investing case here. And first of all, it is that you think margins are going to do better even than the street is estimating. What's going to drive that?
That's right. Margins are at peak level, and that's driven the stock to new highs. But we think margins are going to continue to go higher, at least 70 to 90 basis points higher than the street in 2024. And the primary driver of outperformance relative to street expectations is supply chain costs. We actually have lower supply chain costs embedded in our inventory in the balance sheet. As they sell that inventory, it's going to increase gross margins and operating margins. So we see a nice upside there in 2024.
Interesting. Okay. And then also, you think generally there's going to be growth in the home furnishing sector, and I suppose specifically also for Williams-Sonoma.
Yes, certainly. So the sector itself was very strong during the pandemic. We had people staying at home, redoing their homes, housing took off. And of course, over the last 18 months or so, it's been the quite opposite picture. As we move through 2024, we expect housing to start to grow again, interest rates to come down to help fuel that, and home furnishings to start to increase in sales. So that could be a nice plus for the stock too as we move through 2024.
And then also, there's the idea that Williams-Sonoma has kind of changed how it's done business. It is not discounting as much as it once was. It's kind of holding the line on price. And a lot of people are shopping online for their stuff, right?
Yeah, that's right. There are changes that took place in this company that began before the pandemic. They stopped doing site-wide promotions, and they also started pushing their e-commerce business more, which is now 2/3 of their sales. And the margins in the e-commerce business are much higher than the stores business. So their operating margins are now higher structurally and should stay higher.
My understanding also is that they've also sort of expanded, when you talk about home furnishings, decor is also something they've leaned into a little bit. Furniture, yes, but also selling lots of other stuff.
Yeah, that's right.
In your house.
Yeah, certainly. About half their business is furniture, half is decor. It varies by brand, but for one of the furniture-heavy brands like West Elm, they're starting to move more into decor, and that should help re-accelerate growth in that brand.
Let's talk about what could go wrong, as we like to do here. And there is the risk of higher supply chain costs because of what's going on sort of globally, right?
Yeah, that's right. Certainly the Red Sea crisis is sending ocean freight rates up materially right now. There are surcharges on current rates. However, as we get into the contract renegotiation this spring, our experts, including the supply chain head at IKEA, thinks I'll only see a 10 to 20% increase in freight rates for 2024. And that's not enough to really dial back all that margin improvement that we forecast.
Gotcha. Okay. And then let's get to your stock that you don't like as much in this space, and that is RH. And this stock has already had quite a roller coaster over the past year or so, is down significantly from its highs, as we can see. Here, the company raised prices pretty aggressively. And what happened as a result of that?
Very aggressively. They fired a lot of their core customers. What we call aspirational luxury customers were priced out of RH. They increased their prices by 50% in our sample of goods from 2018 to 2022. And last year, the company's CEO admitted they probably went too far with price increases. So they're on to the next phase.
So the next phase, though, where they are now, did it happen too late? I mean, can you bring those people back, or can you attract new people who can afford to pay those prices?
Yeah, it's not going to be easy. So they are introducing more value-oriented merchandise, so lower price, a little bit lower quality in some cases, and trying to bring that customer back. It remains to be seen whether or not they'll be successful. It's early stages. They plan on reinventing pretty much all of their merchandise, touching every single collection in 2024. So it's a mammoth feat.
And everything has to go right, I guess, when you're talking about that. They're also expanding geographically in Western Europe. So what are you watching to see maybe if they're going to execute well on all of this?
Yeah, so we're watching how the product resonates in the stores. First, if it gets in the stores on time. Peak inflection is expected in the second quarter, but with the shipping delays, that could be delayed. And with execution risk, that could be delayed. As it relates to the expansion in Europe, they have stores so far in a couple countries. The first country they entered, United Kingdom, their store has been a bust. So far off from meeting their sales expectations. And right now, we don't have a huge degree of confidence that the other stores will be super successful.
Interesting. Okay. Then there's another point that you made, which is how this stock is valued, and especially valued versus Williams-Sonoma. So RH is up here, and then you have Williams-Sonoma that is at a much lower valuation here. And that's been they were closer, but RH with its earnings troubles has gotten is a lot more expensive now than it was.
Yeah, that's right. We're talking about forward PEs on our numbers about 22 times for RH, 13 times for Williams-Sonoma. That makes Williams-Sonoma much more attractive in our view. We don't expect a V-shaped recovery in RH's earnings. So with that in mind, Williams-Sonoma is a better buy.
Well, with all of that said, we also like to point out, just like we pointed out, the risks for Williams-Sonoma, the risks to the downside, your downside case for RH, and that's things could go right in theory. What would need to go right though for RH?
Yeah, so execution for one. So if they execute on the product revamp, if they execute on the store expansion, those would be two good things. And the second thing is just the luxury housing market, which they play into. So if luxury housing comes back faster than we forecast, faster than existing home sales overall, that could be a plus for them.
All right, but obviously you don't think that's the case at this point. So let's just summarize what you're telling investors here. Buy Williams-Sonoma, you say operating margins expected to come in above consensus. The home furnishings retail sector expected to grow this year. On the other side, you say avoid RH. It remains to be seen if the company can win back its core customers or even expand its customer base for that matter. Seth, thanks so much for coming in. Really appreciate it.
You got it. Thanks for having me.